Okay, as a manager, you want to maximize your profit, and that maximizing profit decision rely on the choice of quantity of output, right? How many units of output will increase your total revenue while reducing total cost so that you can maximize your profit. That's what have been done. And then the principle was equating marginal revenue and marginal cost once you decide to operate your factory, right? So this output quantity decision, if you think about the process production, can be rewritten or can be represented by the choice of quantity of inputs. Because when you decide how many units of output you want to produce the market, you also have to make decisions simultaneously how many input labor capital you need to insert to produce the target amount of output. So quantity of output decision is essentially same as deciding the quantity of inputs for production. So profit maximizing question, if I re-ask the question, is the following. If a firm has one fixed input, let's say capital, and one variable input, let's say labor, how much of its variable input should it utilize? Quantity of input choices. So I'm going to introduce new concept which is called marginal revenue product. Marginal revenue product. As you are talking about labor input as a variable input, you can say marginal revenue product of labor. So marginal revenue product of labor is the amount an additional unit of the labor variable input adds to the firm's total revenue. So you can basically think that when you hire one more unit of labor, how much additional money or revenue it can earn for the company, right? So marginal revenue product of labor, it is additional earning or revenue it brings by increasing one more unit of labor. So you recall that there's a notion or definition of total revenue, change in total revenue divided by total quantity change, right? You already seen this one, which is called marginal revenue. So marginal revenue is additional earning when you increase the output. But then also, as you divide total revenue by delta Q, you can also multiply change in quantity of output. So eventually these two cancel out. So it doesn't really impact on your fraction original this one. So your original fraction delta TR divided by delta L can be rewritten as multiplied two fractions like this. And the first one is same as marginal revenue. And second one, which define that the change in output when you increase the change in input of labor, how much additional products of output can be produced by hiring one more unit of input, which is defined as marginal product of labor. So marginal revenue product of labor is nothing but the multiplication of marginal revenue from the output and marginal product of labor. So intuitively, when you hire one more input of labor, you will produce additional amount, marginal product, and each additional product of output will generate additional revenue, marginal revenue. So that give you total additional earning from hiring one unit of labor. That is marginal revenue product of labor, right? And then another definition you want to learn is called marginal expenditure on labor. So basically, marginal expenditure labor, as you can read from the slide, is the amount an additional unit of labor adds to the firm's total cost. So basically, when you hire one more unit of labor, how much money do you need to spend to hire that labor or pay for that additional labor? So in case of labor as a variable factor here, marginal expenditure, additional expenditure on labor for one unit more, is same as wage rate per unit of labor, right? So this marginal expenditure labor if we want to decompose it, the change in total cost by increasing the employment of labor by additional unit, and then they can also decompose to two fractions such as total cost change over total output, and again total quantity change divided by total change in labor. And this one you already noted, that is change in total cost by producing one more unit, which is marginal cost, and that is again marginal product of labor, right? So again, marginal expenditure of labor is written as marginal cost multiply marginal product of labor. So both of these, marginal revenue product and marginal expenditure, contains marginal product of labor, same terms. So when company and you as a manager equate marginal revenue and marginal cost as a principle of profit maximization, you are automatically doing the other process, which is equating marginal revenue product of labor and marginal expenditure of labor. So when you equate these, marginal revenue and marginal cost for profit maximization, you are equating marginal revenue product and marginal expenditure at the same time. So again, labor input choice is equal to quantity choice in the short run. So that's the lesson for this video. Thanks for watching.